again, welcome everybody. Thanks for joining us in the next interview with a author series. We've had some really good ones so far, and definitely very excited to do this one with Richard Weissman. He's got a great book. I had the privilege of going through the book here recently, and actually took a lot of notes as I was going through it. So there was a lot of real interesting things that I either learned or some kind of new ways of thinking about trading. And I'm somebody who's obviously been doing this a long time. I mean, with NetPicks for 17 years, and there was still quite a bit of very interesting concepts in the book. So we're definitely excited to have Richard with us. So I guess with that, it's probably a good opportunity right now to introduce everybody to Richard. So I know you're with us. Maybe give us a quick introduction, a little bit of background on yourself, and then we can kind of get started on the interview.
Thanks, Mark, and thanks for asking me on. I guess I started in the industry in 1987. I started as a local on the floor of the New York Futures Exchange, trading stock index futures, and sold my seat a couple of years later and continued to trade off floor from that day until the present day. Have specialized in futures throughout, traded cash forex as well, some options as well, but pretty much I trade exchange-traded futures, everything from stock index futures to forex futures, interest rates, grains, other agriculturals, metals, energy. So that's been my focus. I started doing educational seminars in 1993 for a futures brokerage firm out on the West Coast, and then moved back to New York and was working for Thomson Financial, which is now part of Thomson Reuters, training their pricing desk people in commodity pricing, and then was the head of training for FutureSource Bridge, one of the data vendors, and then worked for a competitor of Energy Management Institute, and I've been with Energy Management Institute doing training for them since 2006.
Great, thanks, Richard. Appreciate that. So let's start to talk a little bit about the book itself and some of the things that you discussed in there. And I think for me, one of the things that was interesting right from the beginning was, I looked at the cover, and of course I see the words casino, and I see, the dice, and I've always been a bit of a fan of Las Vegas and how things work there, and of course always being on the player side of it. So, my initial impression was, okay, this is going to talk a lot about, when you're on that side of it. We talk a lot at NetPicks. We have one of our course developers in particular who's a really good poker player, and he talks a lot about all the similarities between that and trading. And as I started to read the book, I actually realized, I don't know why it didn't hit me right away, but a big part of the message is, no, you're not the player here. You're actually positioning yourself, just like the title says, to trade from the casino's perspective. So I thought maybe it'd be good to start maybe with a big sort of top-level explanation of why you kind of use that perspective over the player side, which of course we all know is more the gambling side of the trade. So I thought that'd be good to start.
Right. Well, when I first started teaching these types of courses on trading, one of the things that struck me, and it probably has to do with traders seeking job security, is this myth that there's really no parallel to trading outside of the world of trading. And so that set me to looking for what is the parallel, what could we compare it to that people are very familiar with, and immediately the thing that struck me was the idea of the casino, that you can use the casino as a paradigm in order to understand successful trading. So how does the casino make money? Basically, as soon as the player walks into the casino, whatever game they choose, whatever activity they choose, probability is skewed against them and skewed in favor of the casino. So that's successful trading, having probability skewed in your favor. And in trading, mathematicians, financial mathematicians call that reality positive expectancy, which is not a cutesy way of saying you make money. What it means is after deducting for the cost of doing business, liquidity risk, the spread between the bid and the ask, and commissions, it still makes money, whatever methodology you're employing. But of course, even in the casino world, probability is not enough. And one of the analogies that I use is, suppose some multi-billionaire walks into the casino and has a cashier's check for $1 billion, and they say, turn it into chips. Well, the casino will do that. But when they take their $1 billion worth of chips over to the roulette wheel and say, put it all on red, the casino will not take that bet, even though they know that probability is skewed in their favor. The reality is, on any single spin of the wheel, the player could win. So they force the player to bet smaller, and in that way they ensure that their probability edge will play out in their favor over time. And in the casino world, they call that table limits, and in trading, we call that risk management. So successful trading entails a positive expectancy model, a model that works over time and has probability skewed in its favor, married to risk management, stringent rules of risk management that I discuss in the second chapter of the book. In the casino world, that's really all you need. All you need is probability skewed in your favor plus risk management. But unfortunately, traders need to overcome a psychological disadvantage, which is that we're all programmed the same way. We don't like to lose. So the problem is, sometimes positive expectancy models will have a clustering of losses. So most people can take a single loss, maybe even 2 in a row, maybe 3 in a row. After 3 in a row, they give up. So the analogy that I use is that imagine there's an opaque urn in the center of this room. By definition, it's opaque. You can't see what's inside of it, but I'm telling you what's inside of it. Inside of it are 100 balls. 60 of them are green and 40 are red. So now bet on a color. Everyone picks the green ball. Out pops the red one. Do it again. Now there's only 39 red balls. And again, green even more so. Out pops the second red ball. Do it again. Now even more so. Pick the green ball. Out pops the third red ball. And like I tell people that are taking my courses, after the third red ball in a row, if you're very fortunate, you say, this is not for me, and you go on and go back to school and become a doctor or something like that. But if you're stubborn, you start betting on the red ball, and then the green ones come out, and then you're really done. So the tools that are discussed in the third part of the book, which have to do with trader psychology, are all tools in order to help us to bet on the green ball when the red ones come out in clusters. And of course, risk management itself helps us to continue to be able to bet on the green ball when the red ones come out in clusters. So that's really the casino paradigm, is positive expectancy, risk management, and discipline, trader discipline.
Yeah, it's interesting because as I was going through the book, at one point I took some notes and I was like, okay, here's the formula that I think Richard is trying to get across, and that's exactly what I wrote. I go positive expectancy plus risk management plus, and I think you said having the confidence in the model through the inevitable periods where it underperforms. Yep. You know, having basically the courage to be unwavering in front of losses. And I think the last thing that I kind of wrote down to that formula was it has to fit your personality. So even if you had everything, it still has to fit the individual, right? Because every individual is a little bit different on what they can kind of handle or take.
Yep, that's dead on, Mark. Basically, what I found is that it has nothing to do, or very little to do, with the best possible trading model out there. In other words, I could give someone and publish in the Wall Street Journal the absolute best trading model that I've ever developed. 99.9% of the people reading that article would never trade it because it does not fit their trading personality. So every trading personality is different, and the way that I break down trading personalities is based upon holding time or time frame. So the traditional way that this is done is we call the shortest holding time scalpers, people that are holding for seconds or maybe minutes, and then you move from there to day traders, and then from there you move to swing traders, people that hold trades from 2 to 10 days, and then longer term traders, people that hold from 11 days out to, let's say, 6 months, potentially even longer. And so the key is, in order to maintain that disciplined approach to trading, is to first of all develop a positive expectancy model, make sure it matches your trading personality, because that's what's going to give you the discipline in order to stick with it during the shallow times, and also the discipline in order to let it play itself out over time. And I have all sorts of tools and techniques that are in the second portion of the book. The first 3 chapters talk about the casino paradigm. The second part of the book, before you get to the trader psychology part, which is the last part, talks about tools and techniques in order to identify what type of trader you are, and how to best take advantage of the tools that are at your access, given your trading hold time frame.
Yeah, I think one of my favorite chapters was later in the book, chapter 11, and I think it's called Analyzing Performance, the Due Diligence Questionnaire. And you talk a little bit about, you've worked with commodity pools, etc. And this is something that they have to do and answer all about their funds for traders who are considering investing. And it's really an amazing set of questions that a trader really needs to ask themselves about everything from the system to the peaks, the valleys, the drawdowns, the losses, to the markets that are traded times a day. And I would almost bet, kind of like the odds that you said, that 99% of the people, if they read that chapter, would say, I've never asked myself even 10% of these questions. But then I always think, well, there's a reason then that most people fail at their trading. How would you kind of how important is that due diligence questionnaire? Where did that kind of come into play?
Yeah, here's the thing, is that basically I've been working over the years training individual speculators, speculators that work for corporations, and commercial hedgers. And one of the things that became apparent to me as I was working through verbally the materials that compose Chapter 11 is that people had a resistance to it. Oh, that seems like a lot of work. I really don't have the time to take notes and to analyze all my trades and to keep a trading journal. And so I said to them, well, the reality is that the traders that you're competing against, hedge fund managers, they're all asked to perform this due diligence by institutional investors. If you're a trader working for a hedge fund or a CPO or a CTA, you're asked to do this type of work. So if your competitors are doing this, why wouldn't you do this? So it's really, I think people are lulled into a false sense of security when it comes to trading, and they think that it's a 50-50 shot. The market can only go up or down. But in reality, it's not. It's a 95-5 shot, that 95% of the people that experiment with speculative trading will not succeed. And one of the main reasons why they don't succeed is because they're not willing to put in the hard work in terms of research, in terms of understanding who they are. So Chapter 11 was my response to that, was saying, look, this is the industry standard from the the creme de la creme of industry professionals, and bring yourself up to that notch in terms of performance, and you'll be successful.
Yeah, I think it's kind of back to having the confidence. I can speak to my own personal trading, and then Brian, who talked in the very beginning here, kind of knows what I'm saying here. Is we managed some funds, and we had a streak of 20+ days where it felt almost like we couldn't miss. Every single day was positive. It just seemed like it was just almost anything we did just worked. And then over maybe the last week or so, there's been 2 or 3 much tougher days overall. And it's amazing how you can go through 20, 25 straight great days, and the second you have that one negative day, it could literally undermine everything that came before, because psychologically it's like all we think about, all we dwell upon, and all of a sudden you get this huge fear that things are broken. And I know fear is something that you talk about also in the book, as far as I think you said, like the 2 greatest obstacles to successful trading are fear of loss and fear of uncertainty. And I'd like to say that, of all the years I've been trading, that I don't sometimes have those same fears, but unfortunately it is something that, I even still feel after all this time. So, I guess maybe talk on that a little bit.
Yeah, I've been doing this almost 25 years now. I still struggle with that. I just went through a period of drawdown in whatever it was, I think it was November, where I had the largest drawdown that I've had in a couple of years, and in terms of industry drawdowns, it was very, very, mild. But for me, it was a big deal. And one of the things that I do when I go through these drawdown periods, and by the way, no matter how good of a trader you are, losses and drawdowns are just part of the business. That's the business that you've chosen. You've chosen to be in the business of taking losses. I like to say that any idiot can take a profit, but professionals know how to take losses efficiently, as quickly as they can be identified. So one of the tools that I use is, and it speaks to risk management, is, I think Larry Hite was probably one of the first people to record the 1% rule in Jack Schwager's book, Market Wizards, which means that you don't risk more than 1% of assets under management on a single trading idea. And depending on what you're trading and the type of model that you're trading, maybe you could go up to 2%. But those are maximum levels. When things aren't working well, there's nothing preventing you from doing underleveraged trading, from trading less than 1%. And if things are going in a suboptimal negative clustering pattern, you could trade 1/10 of 1%. And the feedback that I've gotten when I introduced this idea of underleveraged trading was, people will ask, well, what's the point of trading at all? Just sit on the sidelines. But my feeling is that you can paper trade, but you won't get the emotion of real trading. Even if it's underleveraged trading, you'll still feel the pain of loss. You'll still feel the euphoria of success. And those emotions are what you're learning to temper through adherence to your model and risk management. So I think it's very important to kind of keep your toe in the game, even if you're doing underleveraged trading.
Right. I mean, we, since we're system developers and trainers, and I know you do a lot of training as well. I mean, one of the things that we run into a lot is when we start to talk about using responsible risk management, we kind of take away people's get-rich-quick opportunity. Mm-hmm. And you right. take away the individual's opportunity to get rich quick, and suddenly they don't want to hear anything else you literally have to say, because there's plenty of people who will tell them that, oh, you can get rich quick in trading. So when you're talking 1%, 2% or less, and we talk that, it's amazing how that literally will sort of like shut people down. But you mentioned Larry Hite, and you had a quote in your book too that he had said, if you don't bet, you can't win. Which we got to trade, but if you lose right. all your chips, you can't bet. So right. I mean, I think that's it's a great statement, but it is always amazing to me because we have to, we deal with a lot of individuals too that struggle with all these things, and telling them about risk management is one thing, but people just don't see the path to long-term success. But you definitely clearly state that you can be a successful professional speculator. It's just the reality is the odds, right, are against you. And obviously the idea here is to sort of talk through the obstacles that people run into and, kind of how we can kind of help them get over some of those things.
Right. And, speaking to that, that's why I began to develop these regret minimization tools, which actually composes an entire chapter of the book. Let me just see my notes here. I think it's chapter 6 is minimizing trader regret. And what I state in that chapter, I kind of take the idea that's introduced in chapter 3, the analogy of the opaque urn and the 100 balls, and say that regret minimization tools, what you're trying to do here is not improve necessarily the risk-adjusted rate of return, but regret minimization tools help with trader discipline problems. So I expand on that analogy and say, okay, so let's say there's still 100 balls. You haven't changed that. But what if I could tell you that you could take every one of those green balls and cut it in thirds? Now your odds of pulling out a green piece versus a red piece have improved. Even though you haven't improved the risk-adjusted rate of return per se, regret minimization tools are helpful because we like to win. What happened when I was on the floor in '87 was that, it basically was a great little incubator of education because you had a million different traders down there and everyone had a slightly different style. And as a newcomer, as long as you weren't obnoxious and were willing to listen and learn, you had lots of people there that were willing to teach you. And one of the old guys, he used to be a corn trader, he said to me, you're messing around here, just follow the trend. And I said, yeah, but, trend following, you end up with more losing trades than winning trades, and you have to take big drawdowns. And he kind of threw a piece of paper at my head and said, that's trading, just deal with it. And so I kind of did try and deal with it, and that's how I first got it into spread trading, because spread trading, obviously, there was always a side that you were long, there was a side that you were short, and so it enabled you to stick with trades longer, even if you were under leveraged. But I kept thinking about the problem over time, and that's how I developed these regret minimization tools. Now, the caveat is you can't use them if trading multiple contracts would result in over-leveraging and exceeding the 1% rule in risk management. But if you could trade multiple contracts without exceeding the risk management criteria, what this forces you to do is twofold. First of all, it enables you to take a piece off the table and capture the high probability, high reward point, let's say, whatever you define that as. Let's say 2 standard deviations according to the 20-day simple moving average in Bollinger Bands. So you buy a breakout, let's say, it's a trend following breakout system. Take off 2/3 of the position into the upper band. And then the remaining 1/3 you trail. And this minimizes the regret, because the regret for trend followers is that it had the breakout, you didn't capture the profits, and then it came right back in your face, you got stopped out with a loss. And that kind of dovetails into one of my rules of trading, which is never allow a significant unrealized profit to turn into a significant realized loss. So as soon as you can identify a statistically significant unrealized profit, take a piece of the trade off, move the stop on the remainder to break even, and then trail, let the market's own dynamics determine when you get out of that remaining piece of the trade. And that's what I call regret minimization tools. The beautiful thing about regret minimization tools is that it forces us to think strategically and to get away from this myth of the perfect entry point and perfect exit point. Because by definition, utilizing these sets of tools, you'll never get the perfect exit point because you're not taking a single exit point.
Yeah, I think it reminded me of an area where you talked a little bit about, you were trading and you say that your personal trading, I believe you said, is not 100% mechanical, but it's 100% rule-based. So I think I would assume in some of the regret minimization, by having rules that sort of tell you what to do in those kind of tough decision points, I would assume that that's part of, kind of what helps you sort of overcome the second guessing that we all typically go through if we do not have those rules. I mean, is that correct?
Yeah, I mean, that's the beauty of mathematical technical analysis, is that it forces you to look at statistical objective points. So, I don't think that technical analysis is the only tool that a trader can use, and I like to augment technicals with fundamentals, and I discuss that a little bit in the book as well. But where mathematical technical analysis really comes into really shows its value is with determining what is a statistically significant unrealized profit. So you can do that in lots of different ways. You can use that with a Bollinger Band difference or with average true range. I won't go into the details. The details are all in the book. You can find the definitions of those mathematical formulas online as well. But the basic bottom line is you're using some statistically objective measure to take away some of that guesswork and say, okay, this is 2 standard deviations. This is a logical place mathematically and objectively to take some off the table, and it reduces that emotionalism. So that's the key with those types of tools, I think, and that's where they really add value.
Yeah, I think you also kind of add to that. I think you say that you should add some trader intuition. Of course, that comes with experience. At NetPicks, we always say it's sort of the art of trading. We like to say we've got 90% mechanical and 10% is sort of the art of trading, or I guess in your case when you sort of discuss the intuition, because you make the point a little bit later in the book that while mechanical trading can be really quite robust, it does underperform the very best discretionary traders, but then you go on to say that using mechanical systems is still the most reliable way to sort of turn negative to positive expectancies for most traders. So I mean, it does seem like that's the place to be. Definitely having that full rule set, knowing what to do in every situation. I know in my personal trading, if I didn't really have a rule for every situation, emotionally alone, anxiety, psychologically, it would be really, really difficult. And then how do you get through the losing streaks? How do you even know, when to trail, when to exit out without those rules? But I think a lot of people, go into trading without all that defined. It's kind of like when we offer them one of our systems like the 7 Summits Trader, and it's all spelled out for them. It's still difficult to follow. It's still very hard for people to actually follow those rules, despite it being, there's a perfect roadmap that they should follow. I think still most people have a hard time doing that.
Yeah, in the book I outline the 3 stages of a trader's career, assuming they stick with it. In the beginning, unless you're a market maker or you're working for commercial interest, just hedging, so you're equal and opposite to the physical, the beginning stage of a career of a trader is losing money. And the key point is, how do we get from the losing camp into the winning camp? Mechanical trading systems are the safest, most reliable way of making that transition. Once you've transitioned into the winning camp, now you're an intermediate stage trader, where you have the ability to succeed, you have the confidence, and generally that confidence comes from a mechanical trading system, in your ability to survive long term, and that is a great leap forward in trading. A couple of the limitations to that stage in your career are that you've just come from the world of losing, and so you can be kind of gun shy. You have the discipline where you're going to continue to trade, but you're not optimizing your opportunities because fresh in your mind was how easy it was to lose. So the 1% rule can act as a double-edged sword. It can prevent you from becoming over-leveraged, but it can also, when things are going well, force you to maximize the opportunities that are out there and at your access. The other thing about the intermediate stage in a trader's career is that, generally speaking, it will be accompanied by a single methodology or a single model that works. So in other words, I think in the book I use the analogy of someone lost at sea, struggling to survive in the open ocean, and suddenly they find a life raft, and that life raft is the mechanical trading system. And so they cling to it like grim death, because they know if they let go of that life raft, they're going to be drowning in water again. But once an ocean liner comes along, you get rid of the life raft. Because you have something more robust, and that's the transition from intermediate to advanced stage, and that could be that the augmentation of, let's say you were unsuccessful. Finally, you find a model that works for you. It's a trend-following model, and again, you cling to it like grim death. But it's very easy to become complacent and say, finally, I've got something that works. I'm not going to touch it. I'm not going to do anything. I'm just going to stick right here. But growth and development as a trader entails expansion and thinking outside of the box and continuing to evolve as a trader. And so one of the ways that I've found that's successful in terms of getting someone beyond that first inertia point as an intermediate trader is, if you found success as a trend follower, go on and move and accentuate that success by using counter trend systems. And again, you know, in the beginning, just start doing research on mechanical trading systems that are counter trend, and then as you get more confidence and you begin to see success, take it up to the 1% risk, and suddenly now you have two tools at your access. And then finally, the real kind of foray into the what I would call the advanced trader stage is where you're able to augment all these mechanical systems with trader intuition. And that just comes from experience. You see enough data points, you get enough data points under your belt. And I think in the book I use the analogy of the horror movie. Right. That when the first time you see The Exorcist, you don't know what the hell's going to happen, and you know, you're scared out of your wits, and by the 100th time you see it, you're laughing. It's a comedy because you know exactly what's going to happen, and it loses all of its emotional charge. That's the way trading is. You get enough data points under your belt, and you see the way markets react when they get some, you know, overblown piece of news that they overreact to it, and you get an intuition of, at the very least, take some off here, move my stop to break even, or potentially, you know, even be more aggressive and fade the action. You know, buy the rumor, sell the news is the cliche.
Yeah, I was trying to think here at Netpix, like with our systems, I don't think we have any, as I was sort of going through them in my mind, that are just trend or just counter trend, the way that as I'm thinking it through, everyone has both, because same thing, I just don't think we could have any, you know, any kind of regular continued success if we had just one or the other. There's definitely extended periods of time where the market is just in an amazing trend, and if you have a trend-based system, you're going to absolutely clean up, but unfortunately that always ends, and it starts to go sideways, whether you're a day trader or a swing trader or a long-term trader. So, I mean, I'm a big proponent of that. I completely agree. You have to have both. I think if you don't, I think you'll eventually, even if you're doing well now, I think eventually you're going to end up losing at that point. There's an interesting, a little bit later in the book as well, and it's one of the ratios I think it's kind of rarely talked about, and it was kind of funny because recently I was looking at a sort of a managed trading site for Forex, and it was, you know, individuals were able to get into and choose from literally hundreds of different managers. It's, you know, it seemed like a really slick idea. But I started going through some of the numbers, and there definitely were some good managers, but there were a lot of people with very nice profits, but they had some pretty outrageous drawdowns. And so you talk about this one ratio, and I'm not sure how many traders even think about this, but it's profit to maximum drawdown ratio. So basically taking the net profit to the drawdown, and of course you want that to be as high as possible. I guess one question I would have is, do you typically look at that ratio when you think about that as far as like annual profits, monthly profits, all-time profits? Because obviously that ratio can get skewed quite a bit based upon the time frame that we're looking at. Kind of what's your take on that? I think it's such an important number.
Yeah, the way I run it myself in my own trading journal is that I run it as two separate numbers. I run the monthly profit to maximum drawdown ratio, and then I also run a cumulative profit to maximum drawdown ratio. And so on the monthly, you're going to see the numbers varying quite a bit, and you know, you'll have a different criteria of what is robust. You know, like a 0.2 might even be robust on a given month. In general, you want to see, you know, I'm sorry, a 2.0 might even be robust. Generally, you want to see like a 3 or a 3.5. But on the cumulative, that's going to, once you have the maximum drawdown, that could be the maximum drawdown for years, and the profits will keep accumulating over time as you get more and more profitable months under your belt. So there, depending on how long the time frame is, you want to see some really strong numbers like 7s, 8s, 9s, even, you know, even higher, in order to know that you've got something robust. So the longer the time frame, the higher that profit to maximum drawdown ratio should be. So let's say on a 10-year back test, you want to see numbers in the 7s, 8s in order to say that it's anything worthwhile, worth pursuing.
Yeah, I think that's really critical because when I was going through and sort of analyzing some of these very, overall bottom line positive results, it may be like they would show like a monthly average of maybe $5,000 and then a max drawdown of let's say $10,000, and I was like, it's horrible, but everybody gets taken in because then you would see it would say, okay, over the last year they've made 242%, they've made $100,000 on this size account. Then I went in and would look at the comments from the individuals who are following, let's say, this provider, and they're just left and right slamming the person if they caught it in that drawdown. But it's kind of like I'm sort of thinking, wait a minute, the numbers were there for you. You already saw that that ratio could get very bad and very poor, yet the moment things go wrong, it's, like a complaining session about how awful this is. But I think it's because a lot of people don't pay attention to that, kind of what you have, the P to the MD, profit to maximum drawdown. If you cannot handle the 0.5, like, you were mentioning, then, you never should be trading that way. And I think for most people, they shouldn't touch really a system like that, because as much as you think you could be brave in front of it, you're not going to be brave in front of that. It's just once you're doing it in real time, everything kind of gets thrown out the window.
Right. Yeah, I remember reading somewhere that someone did a study and found that 62% of all people are optimists, and it's a tricky thing because trading is it's kind of it's the backwards profession. Every other profession, confidence and optimism are seen as key, and trading is a balancing act. Simultaneously, you have to have confidence in your ability to develop a positive expectancy model. But on any particular trade, on every single trade, you have to be a pessimist. Every trade that you take, you have to think this is going to lose. And that's what people don't do. They think, oh, well, I don't need to be successful in the long run as long as I can make $1 million on this next trade. But again, that next trade could be an absolute washout. So it could be that it's a positive expectancy model, but you're not able to stick around long enough to enjoy the fruits of all that research because you're betting it all on the first trade.
Yeah, I wanted to mention real quick to people as well. I'm sure as we've talked through some things here, you've got some questions, and you can definitely put in your questions anytime, and we will get to a Q&A portion of the interview and discussion here just in a few minutes. So if you have any that have come to mind, go ahead and put those in. But that reminds me when you were talking a lot about, I think you called it the Protestant work ethic, where almost in any other profession, like you say, and we tell people this all the time, what other profession, most professions you come in, you work hard, you do your very best, you always leave with a paycheck. Whereas trading, you come in, you work hard, and you literally not only may leave with nothing, you have a very good chance you may leave with less than you started. And people I sometimes feel, I think that they can overcome that, right, by just working even harder and digging in even more, and they feel like maybe they can influence what's happening with the trade, whether it's yelling at the screen or kicking something or whatever. And the reality is none of that really tends to matter.
Right. Yeah. One of the things that I discuss is that there's very few things in trading that are guaranteed, and I kind of start the book by looking at that. What can we absolutely say about trading that can never be contradicted? We can say it's multifaceted, that it's not just about markets going in one direction forever. It's not just about markets going back and forth forever, that whatever you think it is, it's going to change and not display that same behavior over and over again. Whereas I like to say markets change, they change again, they change all the time, they change when you think that they're going to stay the same, and then they change right back again. So markets are multifaceted. They're uncertain. We absolutely can say that, that we have no certainty as to what's going to happen next in the market, and they're ever changing, which kind of dovetails into the idea that they're multifaceted. So if you deal with the reality of that as your universe, then suddenly you realize that you've got to respect the markets, and the way that you can never control the markets, but what you can absolutely control is how much risk you take in the markets. And so that's your point of control. That's where you have your edge. most people never even get to the point of exploring it or exploiting that edge. But basically, as a speculator, your edge is not an information edge. Your edge is a risk edge. You have the ability to manage risk tighter than any other player in the markets. Commercial interests cannot manage risk that tightly because they have to be equal and opposite to their physical positions in the markets. But a speculator can manage risk as tight as they want.
Yeah, it's interesting because I always sometimes think when we, talk about some of these different things that in a way we're sort of, almost like crushing people's dreams, because obviously we take away the get rich quick and we talk a lot about the risk and we talk about, a lot of the challenges. There's a point in the book as well, there's a chapter, and I think it's like baby needs a new pair of shoes to kind of sort of get back to the casino and gambling mentality. And we get asked this all the time. They go, Mark, I've got $5,000. I need to make $500 a day. And they start to look at the market in that way. And then once again, we have to come along, sadly, and crush that dream because it's just simply not a reality. And I think you point blank say it as well, that the market could care less about you, could care what you need each and every day. The next trade has no bearing on the trade that came before, yet people still want to sort of treat it that way. And once again, we got to sort of step on that desire to feel like you could pull out $1,000 a day out of the market every single day, and there is somehow a system that can reliably do that. And I've always found in my trading, one day it could be $100, the next day it could be $5,000, the next day it could be minus $2,000. I don't really know how you get to that point of consistency. I mean, in your experience, do you think you even can get to that point?
No, you have to make your peace with inconsistency. I make a living inconsistently, which is a beautiful thing because what that means is that with uncertainty, I have absolutely no idea what next month is going to bring. But I know that I'm dealing with a positive expectancy model over the long run, and I'm managing risk on every trade. So I can't tell you what next year's peak to value drawdown in equity is. I can't tell you what the rate of return is going to be or any of those statistics. But I can tell you with absolute certainty that over any given 12-month period, I have a very, very high probability of being positive, and that's enough. That's all I need.
Exactly.
That keeps me happy.
I hear you, because you have a statement in here where you go, it's very short, but to me it almost says it all. It's not magic, it's just math. Play the odds, manage the risk, and you succeed, and has nothing to do with luck or pessimism or displeasing the trading gods. But I think that's truly what it comes down to. It is really just the math of the model, like kind of getting back to the positive expectancy. So if I was to ask you, I'm sure a lot of people listening, we've got different experience levels. More than likely, there's a decent percentage that are sort of in the struggle mode. I mean, what would be your message to them right now based upon kind of where they're at, and maybe, just some sort of top-level tips of what can sort of pull them through, kind of the funk that they might be in at the moment?
Yep. I mean, the true advantage of being a beginner is that you're under-leveraged and you don't have enough money to make huge financial mistakes. So the advantage that you have is whatever mistakes you're going to make in the beginning of your career, and by definition, the beginning of your career, it's going to be littered with mistakes. Make your peace with it. Make your peace with the fact that, think of it not as I'm going to beat the market and I'm going to take $1 million out of the market with my $50,000 account or my $100,000 account, but instead look at it like this. When you enter medical school, with the understanding that you're going to lose money. You're going to spend money every year on your tuition, and you're going to lose and you're going to learn, and then at the end of that period, you're going to end up with an MD and you're going to make money for the rest of your life. In trading, unfortunately, we don't end up with an MD. We don't end up with a degree that proves that we've undergone that educational experience and that we've spent the money required and we've passed the test required in order to prove that we are, able to do this professionally. Excuse me. The only thing we have is our track record. But the interesting thing is that's the only thing the industry will require of us. The track record proves to everyone, including yourself, that you've now paid your tuition and you're ready to earn a living with this career for the rest of your lives. So think of this beginning period as a period where you're going to pay your dues. You're going to pay your dues to your mentors. Your mentors, you'll never see them, but they are the successful traders who've gone through the process that you're currently going through of losing money and paying their tuition. And they're going to take your money, but if you're able to reduce the risk and trade smaller and just look at it as a learning experience and have a long-term view and say, I'm not in this for the next year or 2 years, I'm in this for the next 30, 40 years, then your odds of success greatly increase.
Right, because I know I can point blank say, having worked with thousands of traders over the years, anytime I've talked to somebody who is successful, they've never told me the story how they started out of the gate positive and profitable, and they've never looked back. Every single one of them has told the horror stories. And just like me, when I started, I was unfortunately lucky in the beginning, because that was the worst thing to have happen, was that everything I did seemed to work, because we know how that is. It's like going to Vegas and winning, and you're like, hey, this could be my career. And then, of course, reality sets in pretty quickly, and then you've got terrible habits that you have to break. So people just need to know that this is the path we all followed. The fact is you can get out the other end. I just think it's sort of like what you mentioned too a little bit. You almost have to reprogram yourself, and you have to do a lot of things that are really counterintuitive and counter to how we're programmed as human beings, and that's why it's just can be tough. But certainly if you kind of plug away at that, it's definitely possible. The good news is, as a trader, you're not trying to do something that's never been done before. I mean, there's plenty of people who are successful, so at least we're not trying to cure cancer here or do something that nobody has ever done. But at the same time, it doesn't minimize that it's certainly going to be a challenge. So this would be, I think, a good opportunity to go to a few questions. So if you've got any questions, this would be a good time to type those in, and I'll ask them to Richard. Let me start with one here that says, is a mechanical system anything like a robot or a black box or an EA type of trading system? I'm a newbie, having traded before. Obviously, this is kind of referencing a lot of the, in particular in Forex, there's a lot of robots that are out there that people can buy that are $100, and they work on free trading platforms. So I guess he's asking, when you're talking mechanical system, is it this black box plug-in thing, or is it something completely different?
Right. Now, it could be a black box, but me personally, I tend to shy away from recommending black boxes, not because they don't work. It's absolutely possible that there's a black box out there that can absolutely work. The problem is, because it's a black box, you don't know what goes into it. That's why we call it a black box. It just spits out buy, sell, stand aside, move your stop. And what it assumes is that every trader is exactly the same, that they have the same hold time preferences, that they have the same risk appetite, they have the same reward criteria. And in fact, it's everything we know about trading is counter to that. Every trader is different. So instead of a black box, even if you personally develop something on your own that is less robust than the black box that you could have bought, the fact that you've gone through the process of developing it means that you are tailoring it to your own personality as a trader. And plus, you know what went into it, so you know why it is performing well when it's performing well. You know why it's losing when it's losing, and that gives you the confidence to stay with it during its inevitable suboptimal performance time.
Right, right, and it's always going to draw down. Just understand as soon as you start it. So you're going to definitely start at the day that the drawdown starts. That seems to be sort of a rite of passage with any trading system. There's a question here from Steve, and then I'll ask you in a moment. But I did want to kind of let people know in the book there are, we've talked a lot about some really high-level trading topics, but just so you know, there are dozens of very specific market examples, specific charts. Richard talks about even very specific indicators, like he mentioned, from volatility indicators to true range to Bollinger Bands. and he tries to really make a lot of examples to real things that have happened over the years in the market. So I want to get that point across so people also know that there's a lot of real technical meat to the book as well, beyond some of the real high-level things that we're talking about. And that question here from Stephen is, can you recommend any trading filters that would tell you when not to trade? I know you talk a lot about volatility indicators telling us what type of market we're in, but I mean, have you in your trading come across anything that maybe tells you when to stand aside versus when to be in?
Right. So that actually is an interesting point, and that's what I deal with in the 4th chapter of the book, the cyclical nature of volatility. So it seems like uncertainty is our enemy, and if only we could be certain, then we'd be good traders. But in fact, uncertainty and change are actually our friends, and it's the volatility tools that tell us where we are in the cyclical nature of volatility. So if you think about it, volatility could be in a period of high volatility or low volatility. High volatility, of course it can go higher, but eventually it's going to resolve itself in low volatility. So high volatility environment, once we have evidence that volatility has peaked, then you can start playing the counter trend or mean reversion models. Low volatility, of course it can continue to be low or go even lower, but eventually it's going to resolve itself in high volatility, and so that would favor, when we can identify through these mathematical volatility indicators, when we can identify a low volatility environment, that favors the use of a breakout model, trend following breakout. So those are some of the tools that I would look at as filters. In addition, in the chapter on time frame analysis, I clue the reader into one of the ways that I personally look at filters, which is that you look for a low-risk, high-reward entry point. And you can use something that I call Timeframe Divergence to clue you into that reality. So for example, let's say that that you're looking at 4 charts, a monthly chart, a weekly chart, a daily chart, and an hourly chart. And you see that the monthly, the weekly, and the daily are all pointing up based upon some objective mathematical indicator, like let's say a percentage oscillator like RSI that can't go above 100, can't go below 0. So 50 becomes the equilibrium point. So all of them are in the 60s or 70s. But then on the hourly chart, you see that RSI is giving an oversold reading of, let's say, 20 or 15. That is going to clue you into a low-risk, high-reward opportunity where it'll enable participation in the dominant trend, whatever that trend is, up or down. It doesn't really matter. But it enables you to enter into the trend at a low-risk, high-reward area.
Yeah, I'd add a few things, like in our experience as well on that. Time, like you mentioned, is always, it's like for a day trader, a key thing. We always make sure we have a start time and an end time because, the last thing you want to do is be caught in a really rough sideways day or a day that's just not yielding anything, and you're going to trade it from, the opening bell to the closing bell, and that's going to be typically a disaster for anybody. I think having a time limit, having trend and counter trend built in, because we get asked all the time, well, what's a great filter? Give me a filter that'll prevent me from having those losing trades. And I've never found one that can do that. Like for instance, on one of our systems, the Keltner bells, we have something called a directional filter, and it does a great job. But I tell people right from the start, never expect this filter to basically be able to eliminate all the losing trades, and also realize that any filter you put in is going to eliminate some winning trades.
Right.
About 35% of the trades when you use that filter win, and that means you could literally miss 2, 3, 4, mathematically says, winners in a row, even with something that only wins 35% of the time. And again, people break it because they just can't stand the fact that they stood aside, they used a filter, and they didn't trade. So I'm not a huge fan of a lot of those because I think it's it ends up getting people sort of paralyzed and you second guess it. But I think there's a place for it.
Yeah, I mean, here's how I put it in the book. Everyone needs to ask themselves the question, would you rather have more signals and more false positives, or fewer signals and fewer false positives? And that, again, speaks to trading personalities. Um, so you need to be somewhere in that spectrum, because if you have so many filters, you're never going to get a trade, and now you're not a trader. Now you're just sitting there waiting for the perfect pitch that never comes. But if you don't have any criteria per se, if the criteria is whenever it goes above the 20-day moving average, I buy. Whenever it goes below, I sell. You're going to get so many trades, and very few of them of any quality. So you need to find that sweet spot in the distribution for you and for your trading personality.
Right. Yeah, definitely agree. Andy's got a really good question here. He talks about a casino's edge is about 5.25%, which is enough to win long term, and it is set up front. How do you deal with tactics used by market makers to manipulate the market, stop hunts, etc., that would skew any edge a trader may have? And I actually remember a section in your book specifically where you talk a little bit about this. Maybe there's fear again that people are out to hunt down your stops, etc. So kind of how would you talk about that as far as the positive expectancy and if you have a slight edge, it gets wiped out somehow?
Yeah, here's what I've found personally, that algorithms and that type of thing. The high-frequency trading algorithms have done nothing except make greater liquidity in the markets that I trade. And if anything, if they're manipulating things, they seem to be manipulating things in the favor of my models, because whatever's happened in terms of trading days that have been blamed on high-frequency algorithms have resulted in just stellar, outsized, profitable days for me. So my feeling is, whatever the heck they're doing, let them continue to do it, because it only seems to make things better for me. So I guess my answer is that the more robust your model is, the more it's going to benefit from whatever market makers or high-frequency algorithms are doing out there in general. Of course, there could always be an exception to that rule. That's why you put in stops. But in general, it's only been good for me. So I'm all in favor of it, whatever the heck they're doing.
Right. I mean, I think a lot of what really kind of sort of crushes your edge for a lot of people is you just make mistakes. I mean, it's easy to make mistakes with your order entry, with reading your signal wrong off the chart. It's easy to start kicking in revenge trading. It's easy to break your trade plan. It's easy to trade after you're supposed to stop. It's easy on a losing day to try to force it to be a winning day. I think that's more where people give up their edge, but that's personal responsibility. It's easier to potentially just blame the market or the market makers. I mean, in particular, maybe even on Forex when you're not dealing with a centralized market, and you definitely could be a little victimized by an individual broker who could pretty much print any price they want. But I think if you're outside of maybe Forex, it's just that's not going to be what's going to end up being the reason that you're going to lose money. It's having your stops being hunted down. It's going to be a whole bunch of other things that are going to wipe out your edge. At least that's how I've always seen it.
Yeah, I mean, here's the way I've always said it is that nobody's bigger than the market. So some big high-frequency trading firm could be trying to manipulate the market, and it could be that there's some huge commercial interest that's just been waiting for someone to put some type of huge sell order in with big size so that they could buy the thing, which they need to buy anyway without moving the market on themselves. So the intention could be that I'm going to manipulate the market. Well, be careful, because there's someone even bigger than you that's just been waiting to manipulate it right back on you.
Right.
So I don't really worry too much about manipulation. But then again, I only trade liquid futures contracts.
Right.
If you're dealing with illiquid cash market instruments, then manipulation is something that you need to take into consideration. That's kind of a whole other conversation, and I think that
well, Richard, I really appreciate the conversation. Enjoyed it. I think there was definitely a lot, hopefully, to be learned. I think I would definitely suggest people look into the book. It's readily available, for instance, on Amazon.com or Barnes & Noble. It's Trade Like a Casino, Find Your Edge, Manage Risk, and Win Like the House. Just as a quick reminder, the next author interview, because people always want to know when the next one is, is, as you can see on the screen, February 7th. It's going to be at the same time, so 12 p.m. Eastern, and then you see your other times there as well. And it's with Denise Scholl. It's called Market Mind Games. So, Richard, I guess in closing, once again, I really appreciate you taking the time today and talking to the NetPix audience. Anything you want to say before we close it out?
I just wanted to thank you for inviting me on, Mark. It sounds like your audience is a good target for the work that I'm presenting, and I really.
Well, I think Richard's mic there, it might be good timing, kind of got cut out, so I don't know if he's having a little bit of an internet issue, so I'm glad it kind of sort of happened towards the end. So let me go ahead and just put up once again the book there for you. I know we had a few audio issues during. I saw a couple of comments on that, but I think for the most part we were able to get through it. So again, thanks a lot. I appreciate everybody joining us. Quick little contact info on the screen there as well in case you need to get a hold of us. John was asking really fast. He came a little bit late. Yes, it's been recorded and we'll on the blog, the Trading Tips blog. So if you go to netpix.com/trading tips, trading-tips, or you can just get to it right off of netpix.com. We'll post the replay as soon as that's available over the next couple days. So again, thanks everybody. Appreciate you joining us, and have a great day.